Cost of goods sold, COGS. What is that? Hey taxpayers, it's Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale, and we're back with another installment of What is that? Where we discuss financial terms and topics you may have heard, but we make them super easy to understand. Today, we're talking about cost of goods sold, also known as COGS, and this number is imperative for any business owner who is selling a product or service. So if you're a business owner and you've seen this on your P&L before, or have never even heard of it, tune in and let's start right at the beginning. Cost of goods sold. What is that? COGS, C-O-G-S, short for cost of goods sold, is the direct cost to producing the good that your business sells. This includes the cost of the materials and the cost of direct labor. It does not include indirect expenses, things like rent, utilities, telephone. Those are overhead. In COGS, or cost of goods sold, our focus is what does it cost? What are all the intricate costs that go into producing this product that you sell? When you sell a service, this is typically referred to as cost of sales. So these are the costs that you incur to produce the service that you provide. Here's an example. Let's say you're an automaker. Your cost of goods sold is going to consist of all of the materials and parts that go into building the vehicle. It will include all of the direct labor. These are the people who are working on building the car, and it may even include the delivery to the actual dealership. Costs that you incurred on a car that has not been sold goes into inventory. But costs that you incurred on the cars that have sold goes into COGS. That's why it's called cost of goods sold. So basically, you invest in all of these materials and labor to produce this product. It goes on your balance sheet as inventory. When sold, it moves from inventory to cost of goods sold. When you sell a service, cost of sales can be a bit more creative. Here, we're trying to think about the direct expenses that go into producing this service. For some, it might be filing fees with the government. For others, it might be a software that is used in producing or delivering the service. For others, it might be a subcontracted service that was hired to produce the service that was sold. Cost of goods sold, COGS, or cost of sales, is such an important metric because it takes revenue and reduces it by the expense in which it incurs to produce that revenue. And so when we look at gross profit, which is revenue minus COGS, we're looking to see how efficient a company is being in the materials and production process of producing its product or service. Knowing your cost of goods helps analysts, managers, and shareholders determine what the bottom line is going to be. You see, if your COGS go up, this is the cost of producing your product, this will immediately decrease your bottom line. Prices will likely have to go up in order to continue to maintain the same bottom line. While it is typically beneficial to have a small bottom line for tax purposes, it's not so great for the shareholders who receive less income from the business. This is why businesses try to manage as best as possible their cost of goods sold, their COGS. We hope you enjoyed this latest installment of What is that? Please hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.